everybody. This is John Blank, Chief Equity Strategist and Economist at Zacks Investment Research. Today, we're going to go through oil and gas slides. Before we do that, I want to present the disclosures that these are my views and not those of Zacks Investment Research, and there's no guarantee of results from viewing this slideshow. But this is the standard disclosure. Please read it, and we will move along quickly. So next thing I want to point out today is my story of what I'm talking about today. That is the deep dive into the global story of oil and gas. Obviously, this is relevant right now because of the Russian invasion of the Ukraine and the disruption it has played in the oil and gas markets, driving West Texas Intermediate oil over $100 a barrel. Today, this morning, the 25th, it's actually sunk because of the Chinese COVID shutdowns. We'll get into this dynamic of all this disruption into this market, China, Russia, stories in the Middle East, of course, Europe, United States, everywhere. The world, this is a true global story, if it's not the most global story. So we'll get into demand, consumption, and proved reserves as our first part. Then we'll touch on the producer stock metrics, how these companies in this space are actually quite heterogeneous in the way they produce and supply these markets. And then we'll touch finally on something that's getting pushed to the sidelines right now, but is a hot topic for the last, basically since 2014, over the last decade, is climate change. And it really has changed the dynamics of this market dramatically. It will return to the front of burner when this story of China and Russia pushes its way to the back burner. But when does that happen? Good luck understanding that we're in a very disruptive geopolitical environment. I just want to provide today the bigger, broader macro story for you to start to understand and have better conversations about what is going on in the global market for oil and gas. So, like I said, part one will be a deep dive into oil and gas demand, consumption, and proved reserves. So, my first slide is summary slide of a company. Exxon Mobil, obviously the biggest oil major in the United States, $368 billion market cap, $87 a share stock. Now, what I want to point out here is this stock has gone from a little over $30 a barrel in the shutdown period to almost $90 a barrel. Now, why is this interesting to me? In fact, all it did is retrace its gains to 2018. This stock is actually not above its highs, which is not yet as extremely bullish as you might expect. And you can see that, the shutdown dramatically has suddenly took demand for oil down to lows that had not been seen in years and years and years. But now be more careful about what you're looking at this slide. I show you, and I'm using my arrow, that is 2022 earnings. The brown arrow is 2023 earnings. So don't go too quickly through this slide in terms of tracking the earnings to the stock. The analysts have actually got a more bearish outlook on 2023 than 22 right now. So this is the hedge that they're putting in place. And the market actually is believing the hedge. It's not actually seeing them crank 23 estimates above 2022. Now, you may, as an investor or trader, think that, and that would be a Zacks upside revision to the ranking and take the stock higher. So again, short-term, long-term, really the story is about whether the trading and people are jumping in front of or agreeing with these analysts about 2022 versus 2023. Is this the high right now, or this is not the high? The analysts are telling you it is the high. And I want to keep that in mind here, that the basic presentation the covering analysts right now is that they just simply do not think that these prices will be sustained in 2023. All right, so I've got to start off with global oil demand on the left side for 2019 to 2026, and I've got byproduct demand on the right side, 2019 to 2026. So this is actually a forward look going to 2026. We've got the next few years out. So this is a true forward look. Again, the basic point here is in global oil demand, and that is that Asia Pacific is at 39 million barrels per day. North America and Europe sum to that level. So the growth is in oil demand, and there is growth, is in Asia Pacific, and it's meeting the same level as North America and Europe. So all those years of centuries of immigration have basically made these two areas about the same. I also want to point out that we talk about oil demand, but there's loads of products. I mean, look at how much from a weighting perspective, the various different products that are byproducts of this market. And we can get into it, but it's ethane, naphtha, gasoline, jet or kerosene fuel, gasoil, and diesel, residual fuel for other products. So this is a very, very disparate distinction. Oil demand is your standard thing we talk about a lot, but the byproduct demand is very different, and there are very different sizes to this market. So again, this is getting us into not only regional differences in demand, but also the byproduct demand that's out there. And so the market has a lot of differentiation that you may not understand. And we'll get to that in these slides. So again, if you want these slides from Zacks Professional Services, please call us. I'll provide that number later on. Best solution to a lot of the granularity or not being able to hear or look at the data is to call us at Zacks Professional Services and get these slides. It's why I do this talk, mainly for the color commentary to the slides themselves. The information you can certainly get from us, and please do call us. I will provide that at the end of this video, or you can stop the video at the end and get that number off that final bounce. So again, here we've got the left panel, which is the forward look to 2023. The right panel is a backward look on estimated versus actual consumption. I will tell you that basically we want both. Just to point out a very simple point here is that in general, the natural gas demand is stronger than oil demand. This is something that's kind of new to the market, but it does have some kind of climate factor in play, as well as the ability of the producers of natural gas to keep the price down for natural gas versus the oil market. We'll get into this dynamic, but oil and natural gas markets are very different. Obviously, they're complementary products when they come out of the ground many times, but what happens to them through their midstream and downstream is very different, and their final customers can be very different. So the point is that natural gas actually is still in a very strong demand market. Oil, not so much, regardless of whether you want to count the COVID bounce or not. All right, so here again, I want to get into the other start of the story is, again, it's this hidden story is the climate change issue versus just the standard production of these different coal, oil, and gas, the old fossil fuels. So fossil fuels, the basic story on the right-hand side, you can see that, again, like I told you, natural gas is in the bull market. Coal turned over and rolled over in 2014, has not come back. That is the story here. They're shutting coal production down because of climate emissions. That started in 2014 as a relevant metric, in terms of when policy started to really hammer down on it. And you can see on the left-hand side, hydro is really the growth thing that people don't talk about as much. Wind is the stronger, compound end of the growth thing, and solar is catching up too. So solar and wind are growing much more strongly than hydro, but hydro actually is the bigger story from a non-fossil fuel perspective. So again, you can look through the biofuel, solar, wind, hydro, nuclear story at the bottom, biomass, coal, oil, and gas. These numbers running from 2011 to 2020, or through these charts at the top. It's all for you in these charts from us. So left-hand side is proved reserves of oil. OPEC is in blue, not OPEC is in orange. The right-hand side is proved reserves of natural gas. OPEC, again, in blue, non-OPEC in orange. So OPEC is blue and non-OPEC is orange. And you can see the basic point. OPEC is more fully in charge of oil production. Natural gas production is different. But now, obviously, natural gas production, the non-OPEC perspective, and that orange line for natural gas is the Russian story. So this is the fly in the ointment here, and why there's such a bull market in natural gas right now is because non-OPEC oil, natural gas production is dominated outside of OPEC. And then you look at the OPEC story of oil, why is it $100 a barrel? Part of it is just simply they're not producing it from OPEC. OPEC is not helping the market out. Very different, though. Keep this in mind. These are the very broad differences of these two markets in terms of proved reserves, things that are in the ground, geologists know about, and are telling us, people have control over. All right, so that gives me my backdrop into the actual companies. Oil and gas is long-term investments in companies. And, we're going to get into the geographic and product revenue differences amongst oil and gas companies. And we'll look a little bit into the shareholder metrics, the Dupont and return on capital analysis for some well-known companies. There's hundreds of companies in here. You can go on all day. This is based with the very largest ones that I will talk about. But what we basically want to get into is, what does the company granularity show us vis-a-vis that global demand data that I provided to you? I want to get into this basic breakdown of how you jump from what I showed you at the very highest level to an intermediate top-down level of the companies. So first thing off, just as a performance metric over the last 20 years, did oil and natural gas perform better than stocks and bonds? The answer is no. There's no question about it. The bottom line here, all the way at the third chart, this is the S&P 500, the green line. You can see it basically was, tracking the Russell for years, the blue line, and now the S&P 500 is actually above the Russell in terms of returns perspective through the COVID pandemic period. You can see that right here, and that is the COVID effect, which is large cap, major mega cap companies got to be the winners out of this market, and it's probably because they get the profits out of this market. So, but in this terms of this talk, what we're looking at is oil and gas, and the returns of either the S&P 500 or the Russell was 430 or 520. Oil did 350, or maybe if you look at WTI oil, 313. Natural gas actually did very poorly, 42%. But again, this is a story of the two different markets. Natural gas prices capped themselves lower, so the returns from just simply owning the asset of one or the other was lower. But this, you can see both through the COVID pandemic were bull markets for oil and natural gas. That's the top area. And again, here I'll point it out with the arrow. Those are in bull markets. But again, they're not exceeding the highs, the prior highs, certainly not for natural gas. Oil for certain too. Is gold a better play? I mean, obviously people talk about oil and gold. Actually, owning a barrel of oil is better than owning a barrel of gold, or a troy ounce of gold. And I'll point out the final thing on this slide is USO and UNG. These are ETFs for oil and natural gas. And you can see if you held these things, this was an incredibly bad trade. Just incredibly bad. USO and USG should not be used as tracking metrics for oil and natural gas. There's some mechanical issues with these ETFs that you can see for yourself play out. So do not be beguiled by USO and USG as a tracking tool for this bull market or making a bear market case. Either or, just simply very poor tracking. And that's all I want to point out here. All right, so geographic revenues of some of these oil and gas companies. These are, for the most part, the U.S. companies. I do have BP in total in here. But for in general, and China Petrol, I've got 3. Lind is kind of U.S. and non-U.S. But the basic, out of the 12, I've got probably 8 that are U.S. and 4 that are non-U.S. But the point here is, and again, get the slides from us, because a lot of this is granularity, is the breakdowns of who is domestic and who is not domestic in terms of their productions. Basic point here is a lot of the U.S. names have dominant U.S. positions. Not always the case. I mean, look at Exxon Mobil. It's actually only 40% U.S. and 62% non-U.S. The same is true for BP. They're only 34% U.S. and 66%. So the difference between BP and Exxon Mobil from a geographic perspective is frankly not very different. But then look at Marathon and EOG. They're basically completely U.S. And, the same is true for Kinder Morgan, which is completely U.S. ConocoPhillips. Don't confuse ConocoPhillips like Exxon Mobil. ConocoPhillips is a very domestic name. So keep this in mind. Product revenues, again, same story here. A lot of complexity, a lot of differentiation. Again, get the slides from us to talk through this, but basically pointing out things like refining and marketing, industrial chemicals, engineering, natural gas liquids, refining gas and low carbon, chemical, non-U.S., non-chemicals. I mean, this is a business that has all kinds of stuff going on in it, and don't lose sight of that. All right, so these are the stock tickers. I pulled these together for you from Zacks.com, and what I want to point out is obviously a lot of the names and tickers are American. I don't put that out. I don't put the country in, but a lot of significant number are countries: China, France, the UK, on the left-hand side, and over on the right-hand side, Brazil, Canada, Russia, Colombia, Norway, Spain, and Italy. So again, when you're looking at oil and gas companies, you're looking either at US companies that are listed on the New York Stock Exchange, or you're looking at state-owned companies outside the United States. This is typically the case, and keep this in mind. A lot of these state-owned companies are very inefficient, and again, poorly will track the top-down metrics of these areas. So keep this in mind. Again, use this as a reference later on. I also put this together for you from Wikipedia, which is the upstream, midstream, and downstream breakdown of this industry. These are terms you need to understand here: upstream, midstream, and downstream. Upstream refers to the searching for oil and gas. It is where all the mergers, acquisitions, and divestitures go on, because people are buying and selling proved reserves. Very hot space for buying and selling. This is what happens in the upstream business. The midstream business is the transportation business. So this is anything from pipelines to rails, barges, oil tankers, trucks, moving the stuff around, storing it, wholesaling it. That's the midstream. So upstream, you're searching for it. Down midstream, you're transporting it. And then downstream, you're refining or processing and purifying either oil or gas. So again, this is when we look at the companies, you really need to understand the differences in these upstream, midstream, and downstream companies areas, because it also plays out, as we'll talk about later, in terms of their ESG rankings, because the ESG ratings consider these companies very differently based on whether they're upstream, midstream, or downstream. Right, Dupont Analysis and Return on Capital Employed, ROCE. Dupont Analysis has 5 components. The one I want to point out to you is the third one: earnings before interest and taxes to sales. That's the one worth identifying. So it's the third column over in both the right and left-hand side here. And just look at difference between, basically it's a profit margin. So you can have, the 4 to 6% of the China companies versus the Valero, which is 1.6%, which is because it's just a refining company. It's very low margins for Valero. Then Exxon Mobil, which is actually very profitable, about 10% margins. And then, are they as profitable as a conglomerate as these other groups like Kinder Morgan at 25%? No way. ConocoPhillips, extremely profitable, 28%. So again, this shows you the difference between the product differences and geographic differences that can have a huge impact on the EBIT to sales number. These are very different models and very different companies. Keep this in mind. Again, use this as a reference. Call us at Zacks and get a hold of these slides for the actual tickers. Part 3. All right, I want to get into carbon emissions and ESG ratings. Obviously, this is a story not for the moment, other than the backdrop of Tesla just killing it, producing now 60% annual growth in autos because it's electric. All these countries are demanding that we shift to electric vehicle. This is a huge subject. Don't forget about it in terms of Russia and China. The Shanghai production Tesla is the story there. The shutdown now, but it will not be shut down for long. They're already opening it, and they're going to keep opening more of these electric car producers all over the place. So this is about carbon emissions reductions. And as a stock investor, you need to understand ESG ratings as another subject. Yes, environmental, social, and governance ratings, whether you like them or not, are used to pick stocks by portfolio managers who run ESG groups. So that this is a multi-trillion-dollar space. A better ESG rating will get the stock bought more often than a worse one. So this, again, is something you need to factor in. Again, off into the weeds for some of you, but for others, we need to understand this once we get past this Russia and China, the situation with COVID and Ukraine. Carbon emissions is the story here. Bottom chart, keep this in mind that, years of fossil fuels left reserves globally. There's 52 years of reserves for oil and natural. That's not the issue. The issue up here is the carbon emissions. And that big blue area is Asia Pacific. In the bottom blue area, the very bottom is North America. You can see how much smaller it is versus Asia Pacific, which is huge and growing. Don't pay a lot of attention to 2020 as the shutdown period stopped at 2019, but you can see that actually North America was and has been making some modest progress in reducing carbon emissions, whereas Asia Pacific has not. And this is something that has a negotiating issue with how much do we succeed at if China and India and these other parts of Asia Pacific simply do not start doing carbon emissions reductions in a dramatic fashion at the global level. That's what matters. And this is pointing that out. All right, emission reductions targets. So again, bull market right now for oil and natural gas because of China's shutdowns and Russian invasion of Ukraine and then the sanctions that are going on with them. Massive bull market. People got it right, are making a lot of money. But as I point out to my earlier slide, Exxon Mobil is not above its prior highs in 2018. Stock is not above prior highs. And this is why this is the case. Because if you go with what's termed a net zero scenario in this slide, that's the green line. This is what oil demand looks like in 2030 and natural gas demand to 2030. Again, the curve bends down later for natural gas than oil, and oil is the real issue here. And if you get into the companies, as we talked about in terms of granularity, there's very different strategies for BP, Chevron, ConocoPhillips, Eni, ExxonMobil, Repsol, Shell, Total Energies. These all have very different strategies, but the point is they have a forward look to 2030 to get this under control, improve their ESG ratings. And if they do it, by the way, they're doing it in the face of the fact that, if Tesla and these electric producers work, there's going to be shrinking demand for oil and later on shrinking demand for natural gas. So this is the thing to keep in mind. There is a very bearish story, particularly for oil, in terms of emissions reductions. And if this is all about, if these drastic scenarios play out, if they don't, actually, you can see still stays fairly bullish. So that's the other question you have to ask yourself is, does this ultimately turn out to be where we get emissions reductions in places that are, working on it and diligent and just never really beat the game for China, India, and Asia Pacific? So that gets us to ESG risk. A severe ESG rating, environmental, social, and governance rating, is 40 plus. That's a severe rating. You can see the rating scale applied by this group, Sustain Analytics, goes from 0 to above 40. So who gets a really great rating? The 8 rating here you see by LIN, L-I-N, ticker L-I-N, is somewhat not representative because they are, they're basically a industrial gas provider. That's not really this market. And then at the other end, you have PetroChina and China Chemical, which are in the 50s. But that gets to my point. If you're in the Asia Pacific area, they get a really poor ESG rating. If you're in industrial gas and basically not touching this market, you get a very good rating. So the question really is in the center of the marketplace, which is the difference between, say, a Total or BP, which is at a 30 or 35 rating, versus something like a Kinder Morgan, which is a pipeline at an 18 rating. So if I am buying stocks for my portfolio and I have to do it at an ESG rating, I will buy Kinder Morgan over Total or BP because it gives me that 18.5 ESG risk rating. So again, thinks about things like Halliburton over on the right-hand side, 24.2. Is that better than BP at 35.3? Yeah, because oil field services are not as damaging to the earth as carbon emissions on some of these oil producers. So kind of an interesting wrinkle here to keep in mind is, again, when you're thinking about climate emissions and thinking about companies, you have a disconnect unless you start paying attention to these ESG risk ratings. And that's my point here. There's a lot going on in this marketplace. So thanks for attending today. Again, John Blank. I have a PhD in economics from MIT, and I'm working for Zacks Professional Services today. If you want to get a hold of us, these are the numbers. I told you earlier, this is where you can get the slides and study the granularity and enjoy some of the learning that can be had about a very popular topic right now, oil and gas production and consumption, and the ongoing look at the story as it plays out. So the number for you, 866-794-6065. If you want to get a hold of us on email, strategycall@zackspro.com. We also have a link to the www.zackspro.com to get a hold of us on the web. So again, the main thing, we'd love to hear from you. I hope you enjoyed this. This is what we do for you. in terms of providing information that we think is critical to making better decisions in the marketplace, better decisions for your investors, and better understanding of the world economy. So 866-794-6065. Thank you again. This is John Blank, and we're going to wrap it up.